let's kind of go into it right now. What's going into the marketplace today? Show you my screen. All right. So I've tailored this specifically to our market here in Southern California. All right. Couple stats here. Would you say this is about true on the retail side, guys? Yes, this is about building in a point to about a point and a quarter or so rebate. Okay, rates are in the mid sixes. 15-year, we're looking in the high fives. We are somewhat in a stable rate environment. Okay, I want to say that again. We are in a stabilized rate environment. Right? Some people are saying the marketing, the doom and gloom right now, right? Rates are skyrocketing high. Guys, that's not the message you want to send as a loan officer. Okay. Yes. Have we seen rates shoot up? 100% true, right? Because of the war, because of global unrest and uncertainty right now, crude prices, this and that. But that's not the message you want to get across to your agents and your buyers, right? We are here to close deals. We are here to help people who are on the fence get off the fence, right? We're not here to put people on the fence, right? We are not here to shy away buyers, right? So we are in a stabilized rate environment. It's not the peak, guys. It's not, is it the bottom? No, but it's sure not the peak, okay? We have seen significantly higher rates a few years ago. So we are in a decent rate environment, okay? So drill that into your heads. Before I show the slide, actually, you guys already saw it. I was gonna ask, do you guys even know what the median house price point is right now in Southern California? Okay, look at that. Look at that Inland Empire. I mean, we're talking Inland Empire, right? And not to put down those of folks who are in the Inland Empire, but obviously the Inland Empire is big, vast, great, in many different regards. But we're looking at the high desert, right? We got the low desert. We got pockets of, Bloomington and Colton, right? Right before we get into like the Highland, Redlands area. But even their price point is at $650. Right? Los Angeles or Orange County is higher at 1.2 right now. It's crazy, right? There's a point to this, right? Now, what are you as sales folks? What are you guys facing right now? Right? There's common objections, right? We've already kind of covered it. Rates are too high. I'm waiting for prices to drop. Oh, I missed the 3% window. Something that you guys constantly hear, yes? Yeah? I'm hearing it all the time. Oh my gosh, I should have bought when the rates were in the threes. I should have bought, when the prices were a little bit lower. A lot of shoulda, woulda, coulda, right? And so what is the comeback to that? The reality, how do you reframe those comments? Okay. One, when someone is saying that the prices are too high, I'm gonna wait for it to drop. Number one, are you guys seeing that the prices of homes are actually dropping significantly? It's not. It's a flat out truth that it's not significantly dropping. Okay. I'll give you, I should have brought it up. I had it. I closed my windows. I forgot it. There is an agent in one of the brokers that I support. They had a listing in Irvine. It basically went for $120,000 or $125,000 over asking price. Still in this marketplace. Okay.
Hi, Celine. I'm so sorry, but you said in the afternoon, and I told the owner it's going to be sometime in the afternoon, and she said, "Can you tell us the time
Shoot,
frame?" I
can you
said, "I asked you,
Sarah?
when you depart, just alert me so I can alert the
Can you
homeowner
do that?
because I."
Thank you. Yeah, so yes, are people going to see, buyers going to see prices that have come down a little bit? Sure. Okay. But again, it's going to kind of balance it out. You're going to see some prices come down a little bit more. You're going to see other prices go up more. I had a buyer who just offered in Hemet on a manufactured home that was listed for $250,000. It went for 285 in the city of Hemet. Okay, so you're going to see that. Now, the notion of, oh, I should wait. Okay, I want to wait. I wanted things to settle down. Well, how do you reframe that? Waiting could potentially mean higher competition, right? Because they're not the only ones that are waiting. The fact of the matter is, there are a lot of people, a lot of buyers on the fence, and they're waiting for something to happen that's going to be in their benefit. Well, guess what? When all those people who are like-minded are waiting for the market to come down or something to improve, and it does, what's going to happen? All those people that were on the fence are going to get off the fence, just creating more competition. And essentially, what does more competition do? What does more competition do when, yes, thank you, on, it drives the prices up even more. Okay? So it's about reframing what they say. Okay? To reframe, the rates are too high. What are we saying? There's going to be a refinance boom soon. Rates are going to drop, right? You want to reframe whatever objections come their way. Okay. So when it comes to the payment and comes to the rate, right? So here's our actual scenario. This is actual numbers. Okay. On a $900,000 purchase price with 20% down, you're taking a $720,000 loan amount. Okay. At 3% rate, the payment was going to be $3,000. At a 6.4% right now, and that's a retail rate with, again, building in about a point and a half, almost a point and a half rebate, you could get that down to 6.2. Okay. You're looking at like a mid to high $4,000 payment. Okay. And look at that and what's in highlighted. When you talk about mortgages and qualifications, again, we've mentioned this several times. Don't talk about the rate. Okay. Talk about the monthly payment. Because right now, guys, okay, when you're consulting a buyer, okay, I can guarantee you right now, they're not bringing up $2,000, $3,000 payments. Why? Does anyone want to guess why they're not bringing that up right now? Anyone want to take a crack at why they're not really bringing up a $2,000, $3,000 payments?
They don't exist anymore?
Exactly. Right? But what from what point of view does it not exist?
Price of homes.
Price of homes. What else? If On's the other one, I'll just go through this. Rentals. Right? A family of 4, a family of 5, where are they going to rent for $2,000, $3,000 right now in 2026 in Southern California? Nowhere. Maybe, again, if you're in like Lancaster, right? But even then, if you look it up, they're north of $3,000. So it's not in their head, right, that they're gonna get this 3% at a $3,000 payment. So you do want to shift the focus on, hey, look, you're looking at a $900,000 house, $800,000 house. What kind of payment are you expecting? Talk about the payment. Okay, is that payment doable for you? And then you're closing them with, hey, look, in a few months, in about 6 months, and that's going to be another slide here, we are expecting rates to drop into the 5. And look, we can we can reduce that payment by another $500, $600, $700. In some cases, it might even be $1,000, right? So we'll kind of get into that, right? The refinance opportunity, right? So for you as a loan officer, your mindset now has to switch from I just need a deal. I need a deal to I'm going to help someone get into a home because it makes sense. And then I'm going to convert this into more possibilities, more loans, additional commission. Why? Because you're going to refinance them. Heck, you might be able to even do a cash out refinance them or do a HELOC for them, right? You got to change your mindset right now. It's not just a matter of sitting there saying, oh, I need a loan. I need to close this person on a house. No, it's a matter of buyer. Let's get you off the fence because it's better to buy now than later. You're going to build equity. Look, you just told me your payment you're comfortable with is about $4,500 because that's what the rental market is demanding. Okay. Hey, look, that's perfect because on a $920,000 or $900,000 purchase price, if you do 20% down, your monthly principal and interest payment is about $4,500. Yes, there's taxes and insurance, but look, you're gonna have to pay insurance regardless, right? Taxes, you pay it. Yes, it's a lump sum, but it's a tax write-off now, right? And then buyer. You buy now, yes, you're going to kind of, it might be a little bit tight, more than you want, but in 6 months when the rates come down, let's refinance you down into it. You need help? Let's get you a HELOC. Let's pay that off, all your credit debt into a lower payment, right? You're providing hope. You're providing a roadmap. You're providing a clear picture for these buyers. As a loan officer, it's not just about selling the rate or trying to get into a home right now. Okay, build the story, guys. Okay, build the story. As loan officers, if you come across or you're working with a buyer who's just so hung on the rate, okay, so hung on the rate. And they want something because this market is too high, okay? There are things that you can talk about, some tools, okay? You guys can do talk to the agents for seller credits for buy downs, right? We know that there's two types of buy downs, right? There's the permanent buy down, in which you're literally buying the rate down from a 6.5 to a 6.25 or 6% fixed for the duration of the 30-year amortization. Or you do the 2-1 buy downs, right? Or the temporary buy downs, 2-1, 1-1, 1-0, 3-2-1, right? And where you're getting a significantly lower rate for the first year, knowing that the rates are going to drop in the next 6 months to a year, and you can refinance them into a permanent one. But those are always attractive because on a 2-1, you're going from a 6.5 to a 4.5. Right? So you could tell them, hey, we'll get you into a 4.5 rate right now for the next 12 months. Not a big, that's a substantial, significant benefit, right? Even if you do the 1-0 buy down, you're going from a 6.5 to a 5.5. Still a great rate, right? So you got your temporary, and then the ARMs. Okay, the ARMs are case by case, but I have loan officers, or I know loan officers who only sell the ARM right now, okay? Because they just don't want to deal with it. They don't want to deal with selling a high 6 or mid 6. They're like, hey, let's just get you into ARM rate right now, 6%, 5.875. It's fixed for not just 1 year or 2 years. It's fixed solid for 3 years, 5 years, or 7 years. Right now, the market's the best rates are probably on a 5-year ARM. That's a long time, guys. It's a short time, but in the world of mortgage rates, it's a long time, right? It's enough time, more than ample time to see the rates come down, but it's long enough where it's like, hey, for 5 years, you don't have to worry on a reduced rate, right? So use those tools. I know loan officers. I was one of them at one point in my career where I never talked about and never offer these other options. Okay, as simple as it may be, add it to your repertoire. Don't just talk about the 30-year fix. You come off simple. You come off incompetent. Okay, you come off as, hey, that loan officer didn't tell me that or share with me that. Okay, don't be that loan officer. Build it into your repertoire, in your consultation, because guess what? There is going to be a loan officer that's going to help share this and provide this to the borrower, and they're just going to look better than you, the one who didn't share it. Okay, you guys got it? ARMs, buy downs have temporary, even expand the buy downs, right? Temporary and permanent. Sound more educated, sound more competent. Okay, it's all perception. So this is just kind of a summary of what you as a loan officer should be really doing out there. Okay, you're selling the strategy, not the rates, right? I just gave you a long-winded example of selling that picture, that roadmap, right? Pre-approvals. As simple as these all sound, you need to be telling your borrowers, hey, we have a fully credit underwritten pre-approval process for you. Okay? To an extent we do. Why? Because we have Gia and the team and Brenda. Okay? We have a gajillion, assistants here, right? Most of whom are on this call. They're going to look at the file. They're going to run it through AI. They're going to confirm it with the AEs that we can do this. We're going to get the income lined in. You're pulling credit. So we know the DTI is going to be, give or take, within 90 to 95% accurate, right? You have the certainty that's going to be a solid, rock solid pre-approval letter. You're giving it to the borrower with the confidence to go out there to get into escrow without any issues. Potential issues, barring, HOA and the appraisal, right? You have to use that as a tool. Is it simple? Sure. Is it something to just easily, just say, hey, we could just get you that? Sure. No, but it's in your delivery. It's how you relay that information. If I'm a loan officer that says, hey, I could get you a pre-approval. Hey, I could get you a pre-approval. It's going to be fully credit underwritten. We're going to run your credit. We're going to lock in your income because we need to know if the DTI is going to be solid, approvable or not. We're going to go through, we're going to assess your assets to make sure that there's no funky deposits and that, so that when I deliver this pre-approval to you, I want you to know that you can go and shop with the utmost confidence that when that listing agent sees your pre-approval, they're going to be confident in accepting your offer. And on top of that, I, as your loan officer, Jay and Joe, Doe, I'm going to call the listing agent and I'm just going to reassure them that I am going to be on top of it. I'm going to communicate. I stand behind the pre-approval letter because it's been vetted out. And we're going to ensure a closing. We're going to ensure fast, efficient closing. That's what you're going to do, as opposed to the loan officer that says, I can get you a pre-approval letter. You guys see the difference? Okay. It's not rocket science, guys. It's all in the delivery, right? All in the delivery, guys. Number 3, structure creative deals. Right. We just went over it in the slide previous to it. Okay. Offer more. Sound and act and appear to be more competent than your competition. Okay. Because it's true. Buyers are consulting with more, right? As Sarah just shared with, she had someone, shop it with 3 other lenders. Okay. The use of AI. Okay. Why? Because for you to believe in yourself that you can offer provide this pre-approval, you have to back it up as a loan officer. You have to, yes, talk with the Giving Tree processing team. Make sure you talk to the AE and make sure you got the program in line. The guidelines are going to fit this. And importantly too, as we just mentioned earlier, you have to adapt the AI tools. Okay. How do you make sure that you're going to stay on top of it? AI can help you with that. The communication, the emails to all the different parties. Okay. Don't cheat it. Don't lie about it. Don't fabricate it. Don't be that sleazy used car salesman. Okay. When I deliver a pre-approval letter, when I talk to the listing agent, when I talk to the borrower, I do so with the utmost confidence because I do the A to Z's. I do implement AI now. Okay. I have done the whole credit analysis. I have ran the scenarios and the guidelines with the AEs. I do communicate. Okay. I do equip myself with all the tools. Okay. There's a saying in Korean, it's 앞뒤 안 맞아. The front and the back don't match. Okay. 앞뒤 안 맞아. Right? Well, you want it to match. You want the front and the back to match. Okay. That harmonious, that synchronization of selling a product, providing a service has to match. That's the front end, right? The back end is you. Okay. We kind of went over this, the objections. Okay. So that was a repeat. In addition to the objections, guys, right? Rates are stabilizing. You know, we're seeing, you guys see this, right? You see the rates, despite the war, despite the crude oil prices, despite this and that, uncertainty in the marketplace and globally, the wholesale rate keeps, it keeps hovering between like high fives and low sixes, right? It's about a quarter point one way or the other, an eighth point here and there, right? So no, rates are not skyrocket high, okay? And we're not seeing that it's going to shoot to the moon. Could it? We don't know. And if it does, look, we don't have a crystal ball. But as we see it right now, as proven by historical data, okay, and in the near future, rates are still holding, wholesale rates around 6, retail rates around 6.5, mid sixes. And the prices are still moderately increasing. Okay, these are all facts from data from CAR. Okay. In closing, what I want to say to you guys is 2026 isn't about low rates. Okay. It's not about high price homes. Okay. It's about high skilled loan officers. Okay. I'm going to say it again and please let it sink in and say it to yourself right now. 2026 is about high skilled loan officers. Okay. I know I've picked on him a couple times already before. I'm going to pick on him again because I really am proud of him. I keep saying that, but Alex has not been in this industry for a long time. When you talk to him, he talks as if he's already a high skilled loan officer. Okay. He's implemented AI. He just shared his win for the week. He's doing a 6 unit. You guys understand a 6 unit is considered a commercial property at that point. That's how it's classified. Yes, it's residential, but from the lending standpoint, it's going to be under the umbrella of commercial financing. Okay. Because Fannie and Freddie, remember, classifies 1 to 4 as residential, not 5 and not 6, not 10, right? Up to 4. So it's about high skill, guys. You have to take on all of this that we just covered today. You have to take on the tools, the physical tools, the know-how, right? And really more importantly, guys, is the delivery, is how you communicate to the buyer. Okay, if you want to win that lead, and as well as the agents, for them to refer you the lead. There is a bonus slide here. Okay, asset-based lending. I told you. So that everything that you guys all shared. So this is kind of pertaining to what Alex shared. Okay, Right now, I'm doing 2 commercial deals myself. One's a gas station and one's a hotel. Okay. I don't want to go over because we're already at 10:30. I think there's a transitioning period in the marketplace right now. I'm not saying this is all of mortgage and all of residential, but there is an intertwining right now that we have not seen. I would argue ever, because obviously we had now, 2008 we had Dodd-Frank, and then 2014 we had non-QM, and so non-QM is blending. Okay, non-QM is blending residential and commercial. Okay, you guys do understand that DSCR, right, while it's used for residential purposes, financing, it is a commercial method, commercial financing method. Okay, now with that being said, right, we commonly hear DSCR, fix and flips, rental properties, short-term properties. There's terms that you hear like ARV because of, renovation loans, construction ground up, right? We are, what I didn't put in there is, multifamily, right? And when I say multifamily, I mean more than 5 or more. So the commercial space, right? But these are all residential properties, okay? But it's being looked at through the lens of commercial financing. And we're seeing more and more of this. Why? Okay, why? It's simple. 1, prices are exorbitantly high, okay? 2, there's more you guys do see that there's more investors in the marketplace now. I mean, whether that's because we can thank Airbnb and VRBO and all of that, but there are way more investors. Yes, you guys all agree with that, right? It's not unusual for your friend to be like, oh, I have a rental property. Oh, I'm Airbnb-ing this property out. It's more and more. Before, it was all commercial, right? It was big commercial landlords, right? Or investors. Now it's mom and pops, right? There's just more money now. There's more money. The United States, we print more money, right? We keep going into debt. I don't like saying this, but it is the truth. The rich have gotten richer, right? The rich have gotten richer. It's the truth, right? You guys know that. There's a development now are, more developments of not just a single family property, right? But it's condos and apartments, right? And 4plexes and 6plexes now. That's what everyone is getting into. Why? Because it's, hey, get a rental property. Get a rental property. And more of the middle class want to get into that middle rental property. There's a lot of different reasons. But it's blending commercial lending and residential lending. Okay. And so right now at Giving Tree, as Alex had mentioned, we have RCN. There's LendSure, there's LendMe. Get yourself familiar with some of these. Reach out to the AEs and talk to them, okay, about commercial and hard money, really. We have Lendistry. We have, what's the one I'm thinking of right now? Velocity, right? Velocity that does like 35% down, and you could get, you could basically qualify for almost anything when it comes to real estate. There's a few others, but talk to your AEs about this. Talk to that, get in that space, start having conversations. Quick story, and I'll wrap it up. I'm helping this guy, a client of mine, purchasing a home. It's a for sale by owner, son to father. Okay. Long story short, we can't go conventional financing because of, again, long story short, but because of a bailout situation. So I talked to one of our outlets here in Hard Money. And right now, by the way, Hard Money, it's very interesting now. It's not just pure hard money and there's commercial. There's a blend now. Okay. There's a blend of hard money and commercial. Okay. So we found someone that is able to do the transaction, though it's family, using a gift of equity. And it's a hybrid between a hard money and conventional loan or commercial lending, because we're treating it as an investment property. And thankfully the son already owns a primary. So they're gonna help the father out by acquiring the property as an investment property. Well, one thing led to another, and they have a gas station. And so now I'm refinancing their gas station right now. And because I'm refinancing their gas station, they referred me to their broker, Mr. Dan something, and he just gave me 3 hotel deals. Okay, so I'm doing a La Quinta hotel in Disneyland, and there's 2 more. There's one in Monrovia and the other one in Glendora or Glendale. Glendora. Yeah, Glendora. But he already gave me those, but we're trying to finish up this Disneyland one. Okay, guys, commercial has big time money, right? You even charge a half a point on $7 million. What is that? That's still $35,000, right? So have conversations. That's what I'm really encouraging you. Be equipped. Okay, change how you present things. Don't be so simple about it. Okay. Any question, guys? See, are you on? If not, it's okay. But do you have that sample?
I am on.
Awesome. Do you have that sample of the scenario that you ran through?
Yeah, I'll share it really quick.
Okay, great, thank you. I just wanted to share you guys because I haven't done it yet, but she shared with it. Again, it's just I just want to show you guys, if you're not using it, how simple it can be and how how thorough and powerful AI can be, and even like just providing scenarios.
Hey, Rock, can you stop sharing?
Yes.
Okay, I'm gonna go through this really quick, and I'm just a quick disclaimer. This came up because thanks to Alex, there was a call one day where he mentioned that he basically inputs everything about the borrower into Gemini, and I tried it for myself, and it actually saves a lot of time. So what I'm sharing here is my initial analysis email that I sent to a borrower, and I included the agent on it. Okay, so it literally breaks everything down. I mean, it's very detailed, but in a way to where your audience, the consumer, understands it. Okay, and this kind of goes over debt to income, what the estimated payments look like, and right here basically indicates like, hey, your DTI is way too high, right? However, right underneath it, I'm recommending the path to qualification. This is all done through Gemini. I didn't take a single minute with a pen and paper to calculate this at all. Okay, so according to Ragnar, I wasn't on a call, but Ragnar was actually on a team call with the agent, and he actually gave me a shout out because of this email that was sent to the borrower that he was copied on. So I think a lot of times we're not thorough enough as far as why we can't do somebody's loan. So when you start to input everything into Gemini, I'll share with you right now. So this is the part I want to focus on. It's a pretty long chain, but I want to focus on here. So I asked Gemini, the maximum debt to income ratio is 50%. What personal debt can they eliminate to reach this, right? And this is how I was able to create that little chart that was on the email that I sent. So literally by inputting their income, their debt, the future housing expenses of what they're looking to buy, once you input all those basic information, you could start to really ask it questions and do calculations for you. Okay. Like I said, I'm not, it even breaks down like, hey, here's option 1, right? The lowest dollar amount eliminated. Option 2, clearing the small loans, fewer accounts. Option 3, clearing the vehicles. It really gives you something to take a look at and decide which way you want to approach it. Okay, so once again, thanks to Alex. I have to give Alex credit for this, but every new lead that I get now, I actually start a chat within Gemini. I tell Gemini their names, how long they've been at their employers, what they do for a living, how much they earn. If I have pay stubs, I'll upload it. Okay, if I have W-2s, I'll upload it. If I have a credit report, I'll upload that, or I'll just type in what their debts are. And with all that information, you could literally at the very end just tell it, hey, I want to send this information to my client. Draft an email for me. And that email that you guys saw is exactly the result of the input that I put into Gemini.
That's awesome. Great.
It reads Calyx points as well, so you could export a file and upload it to Gemini.
I haven't tried that yet, Alex, but I'll definitely try that. Thank you, sir.
And it's been helping me when I'm trying to do DU. And then you could also, where it says fast, you could change it, right? So you could change it to thinking and then pro, because there's somewhere just like for coding and then for number analysis as well.
Thank you guys.
I tell you guys what, something detailed like this, it not only helps the borrower, but it helps the agent. Okay. Mm-hmm. They're not going to call you afterwards and be like, hey, why don't they qualify? They're not going to do that because they're going to look at your email, assuming that they're actually going to read your email, and they're going to know exactly why they don't qualify and what needs to be done. Okay. So this is an agent who, I've known, but I've also sent these emails to agents who I don't know. And every one of them has come back and told me, hey, I'm really impressed with your analysis. Because no other loan officers out there do that. They send a basic, if it's a pre-approval letter, it's very basic. Hey, you're approved for up to this amount. Even when I send a pre-approval letter, I still send an email with something like this, explaining why they're approved, right? Because now, in case they want to say, hey, what if we want to buy, a 1.2 instead of a 1 million? Well, if you look at my email, you'll know you don't qualify for a 1.2, and here are the reasons why. So if you want to really impress not just the borrowers, but also the referring agent, this is something you should be doing with every single lead, honestly, because no one else is doing it out there.
Yeah, it saves so much time. It's insane.
Yeah.
I was doing it the other day and I was like, just trying to do it by hand compared to Gemini, whereas like Gemini just does it for you almost instantly.
Thank you both for sharing that. Again, it's a matter of winning as a broker. You are the broker, and in order for you to win, look, as the article said, just adapt two ways to implement AI in your business. As these two gentlemen just shared, look, it's not just a matter of saving time and efficiency, but it's just making you look more professional, making you look more competent, right? You just look the part. It's going to help you win. Those little things add up, right? All those little, I want you to take away with this and I'm done. I don't know if you guys ever worked out in your life, okay? But if you ever talk to a bodybuilder or someone who's like a fitness trainer or even someone who's on a diet, okay? They will all tell you the same thing. The reason why that guy is not building the muscle here well enough, or that person is not losing a certain amount of weight there, it's not the bigger things of, oh, I gave up on a pizza today, or I bench pressed this many reps. It's not actually about that. It's about the smaller things. So for the person that's dieting is, can you say no to that extra bite of ice cream? Or the person that just decides not to eat ice cream at all. Okay, to the guy who wants to be all muscled out and fitness guy, it's about, are they willing to do that extra rep? Okay, or is it about? It's about, are they willing in addition to the big bench press? Are they willing to do the flies with the dumbbells? Right, the little things like that. Okay, in our business in mortgage, it's the same thing. Those little things add up in evolving you into being a more powerful loan officer. That's just really the message I want to stress. Thank you guys for sharing. Hope that was helpful, and hope that in the weeks to come that you guys will continue to evolve and transform into bigger, better loan officers. Thank you guys. You guys have a wonderful week. See you guys.